Are you excited to go from watching the stock market to becoming a confident investor? You are in the perfect spot. It doesn't matter if you're new to numbers or a bit unsure about finances. We guarantee that by the end of this video, you'll talk about stocks like an expert and make investments with style. Let's clear things up first. Investing is not some quick path to instant riches. It's easy to get caught up in stories of big earnings, but the truth is that investing is about much more. It's a safe and intelligent way to make your money grow. However, it's important to know that investing isn't solely about making money. It's also about preserving it. Let us illustrate with an example. Imagine you have a $100 bill. Even though it will still be a $100 bill next year, its actual buying power or effective value will be less due to inflation. With a 5% inflation rate, that $100 bill effectively becomes $95 in 1 year and a mere $85 in 3 years. Unless you enjoy seeing 5% of your money disappear yearly, investing in stocks is one of the smartest ways to prevent this erosion. The easiest way to understand how the stock market works is with lemons. Imagine you own a lemonade stand called Super Lemon Drink, which is a hit due to your secret lime recipe. While confident in your business's potential, you need additional capital for expansion. So, you reach out to friends who offer financial assistance. With their contributions, you establish a second lemonade stand and hire staff. However, your friends aren't just lending money, they expect something in return. You grant them ownership or stock in your lemonade venture in exchange for their investment. This transforms both you and your friends into shareholders of Super Lemon Drink. Clarifying terms. A stock refers to the business in which you invest or own a stake. A share is more specific, indicating the smallest unit of stock ownership. To simplify, consider dividing ownership of Super Lemon Drink into 100 shares, each priced at $10. If someone possesses 100 shares, they own the entire business. Johnny, purchasing 15 shares for $150, now possesses 15% ownership, while Sally, who acquires 5 shares for $50, owns 5%. But how do stock prices rise? Suppose your lemonade business prospers, attracting interest and demand for its stock from strangers who believe it's a promising business opportunity despite its unique lime recipe. Strangers approach your friends, the shareholders, with offers to buy their shares. This demand elevates the value of Super Lemon Drink stock. Your friends can ask for more than their initial investment from strangers. For instance, Johnny, who bought shares at $10 each, can now sell them for $25 per share. If he chooses not to sell, he accumulates unrealized gains of $15, hypothetical wealth from the increased share value. However, these gains only materialize when he completes the sale, receiving cash for his shares. Yet another intriguing option exists for Johnny. He can earn cash from his Super Lemon Drink stock even without selling his shares. Imagine the business generating substantial profits and you, the primary owner, wishing to reward your friends, the shareholders, for their belief in the company. You allocate a portion of the profits to them, proportional to their share ownership. Since Johnny owns more shares than Sally, he receives a larger sum. This monetary distribution is termed a dividend. But if you want to grow your wealth in the stock market, we'll show you how to buy and sell a stock step by step later in the video. But first, you need to know the two main types of stock. Firstly, consider individual stocks like M&M candies representing individual companies. These stocks can be purchased and owned, which sounds appealing. However, they come with significant risks. Interestingly, this has nothing to do with yellow, as yellow M&Ms aren't popular. Let's say you have $1,000 and decide to invest it all in a single stock from Company A valued at $1,000. If Company A's stock price falls by 25%, your entire investment declines by $250, a quarter of your initial investment. This isn't a favorable outcome. A wiser approach involves diversification. Instead of investing your entire $1,000 in a single $1,000 stock, consider dividing it into 10 stocks valued at $100 each. This way, your overall investment remains $1,000. If company A's stock price drops by 25%, your investment only reduces by $25, just 2.5% of your total. This method significantly lowers risk. However, handling 10 separate stocks can be overwhelming due to the need for research and management. This brings us to our preferred method, investing in funds. Think of funds as a jar of M&M candies. Like before, each M&M symbolizes a distinct stock. However, this jar or fund holds various stocks. Instead of acquiring individual stocks one by one, you invest in a single fund, which grants you access to all the stocks represented. This simplifies the investment process and decreases risk. 3 primary categories of funds are available for purchase, and the third one is an absolute game changer. Let's delve into them. First, there are mutual funds. These funds are actively managed by a real person known as a fund manager. The fund manager handpicks which M&M-like stocks and investments should be part of the fund. Due to this active management, mutual funds typically come with higher fees. Depending on the mutual fund, there might also be a minimum investment requirements before you can own it. Furthermore, mutual funds are traded only once at the end of the trading day. Even if you attempt to purchase a mutual fund at 11 a.m. Eastern, the transaction won't occur until the market closes. Second, we have ETFs, or exchange-traded funds. ETFs are mostly passively managed, meaning no active fund manager makes stock selections. Consequently, fees associated with ETFs are generally lower than mutual funds. ETFs also demand a lower minimum investment to initiate. Unlike mutual funds, which can only be bought or sold at the market's close, ETFs offer the flexibility of trading throughout the day. Now, our favorite among these options is index funds. Index funds are also passively managed, leading to lower fees. These funds essentially invest in whatever the corresponding index tracks. Imagine an index as a scoreboard indicating how a group of stocks is performing in the market. For instance, the Nasdaq 100 is an index that monitors the performance of 100 significant tech companies. An index fund linked to the Nasdaq 100 index would invest in the stocks the index monitors. Which stocks are included in an index? Each index operates based on several criteria. For instance, let's consider the Nasdaq 100. This index adheres to specific standards, such as requiring companies to have an average daily trading volume of at least 200,000 shares and having over 50% of their shares owned by the public. So, when we delve into the Nasdaq 100 index, we find a lineup of stocks it's keeping an eye on. Examples include CrowdStrike, Datadog, Face Energy, Honeywell, Microsoft, and Meta. If we direct our attention to QQQ, an ETF tracking the Nasdaq 100, we can get an insight into its holdings. The 5 leading holdings in this ETF comprise Microsoft, Apple, Amazon, Nvidia, and Google's parent company, Alphabet. For instance, Microsoft represents 12.51% of the ETF, Apple stands at 12.21%, Amazon holds 6.11%, and so on. Surprisingly, over the past 38 years, which encapsulates market crashes, recessions, and depressions, this index has managed an average annual return ranging from 15% to 17%. Remarkable, isn't it? The strategy here is to identify index funds boasting a commendable track record. In just a moment, I'll divulge my preferred funds. Yet, it's crucial to recognize that all this knowledge is of little use without the right strategies, which we'll share. 3 notable investment strategies we will share. The first technique is technical analysis, scrutinizing stock charts and patterns to forecast future trends. While historical repetition is the basis, studies have shown that natural market randomness often overshadows patterns. However, collective belief in these patterns could lead to self-fulfilling prophecies as actions based on this belief influence the market. Moving to investment strategies, the passive funds approach through dollar cost averaging or DCA is highly favored. This simple and efficient method involves finding a suitable fund and regularly investing a fixed amount of money. Over time, this tends to lower the average cost per share. For instance, investing $200 in Microsoft each month for 5 years would acquire more shares when prices are lower and fewer when prices are higher. DCA mitigates the psychological fear of market volatility. The second preferred strategy entails identifying undervalued stocks. This involves recognizing stocks whose market value is lower than their perceived worth. For instance, if a company theoretically merits $100 per share but is trading at $80 currently, it's considered undervalued. This strategy, termed fundamental analysis, involves scrutinizing a company's financials, earnings potential, and market conditions to make informed investment decisions. To delve deeper into this type of analysis, you can delve into the fundamental analysis, which is comprehensively detailed in my complimentary investing starter kit. You can access this resource through the link provided below. Let's apply fundamental analysis to ExxonMobil, the world's largest publicly traded oil and gas company. During the third quarter of 2022, they reported a year-on-year revenue of $112.07 billion, surpassing expectations by $9.11 billion. The company distributed an additional $15 billion in dividends to its shareholders in the same year. Notably, these positive figures emerged amidst a recession when oil and gas prices usually plummet. A fundamental analysis approach involves recognizing the company's strong performance during the recession. The additional U.S. sanctions on Russia bolstered oil prices, suggesting that ExxonMobil was undervalued. Consequently, over the next month and a half, ExxonMobil's stock price surged by nearly 20%. Identifying undervalued stocks can be time-consuming, but financial ratios and metrics can expedite the process. For instance, the price-to-earnings or P/E ratio gauges a company's stock price relative to its earnings per share or EPS. A higher P/E ratio indicates investors are willing to pay more for each dollar of earnings, potentially signaling overvaluation. Conversely, a lower P/E ratio suggests undervaluation. However, these ratios should be interpreted with data from similar companies in the same industry. To fund your investment account, connect your bank account within the app and make the necessary transfer. We've already deposited $5,000 into this new Moomoo account created for this demonstration. Next, search for the stock or index you're interested in. For the sake of illustration, let's assume you're keen on Apple stock. Upon accessing Apple's stock profile, focus on the stock price and the accompanying chart. One notable feature of Moomoo is its Analysis tab, which presents various insightful data already processed for you. This includes the P/E ratio relative to the industry average, historical performance percentiles, and institutional holdings like Vanguard and BlackRock, and analyst ratings with target prices. This array of valuable information, usually offered for free by other platforms, is freely accessible on Moomoo. Suppose you're satisfied with the data and wish to invest in Apple stock. Click on the trade option followed by buy. While the trade order screen may seem complex, focus on the order type. For beginners, two key order types are market order and limit order. A market order purchases the stock at its current price, while a limit order specifies a desired price or better. For simplicity, let's proceed with a market order. Specify the quantity of shares you wish to purchase, considering the stock's current trading price, and then confirm the order. Congratulations! You've made your first investment. Return to your account page to observe your ownership of the acquired shares. If you intend to sell your Apple shares, the process is akin to buying. Click on Apple, select Trade, opt for Sell, and determine the quantity and order type. Confirm the sale to complete the transaction. As for the best time to begin investing, the ideal time was yesterday, with today being the next best opportunity. However, initiating your investment journey hinges on a few factors. Ensure you've settled high-interest debts, particularly those exceeding a 10% interest rate. Additionally, confirm your commitment to long-term investing and have an emergency fund. If you meet these prerequisites, now is an excellent time to embark on your investment journey. Invest for the extended duration with funds you won't require over the next 3 to 5 years. Ensure you have a financial cushion and an emergency fund to cover unforeseen needs. Additionally, have a clear comprehension of your financial objectives. We understand your aspirations at a deep level. You're eager to employ your money to your advantage, but uncertainty and fear of errors hold you back. You yearn for empowerment and knowledge to transform your wealth. We recognize these feelings because we have been there. Let me assure you that you're on the right track. However, realize that you can't fulfill your financial ambitions by merely stashing your money away. Traditional savings accounts yield an average interest rate of 0.06%. Suppose you deposit $15,000 and add $500 monthly. It would take 157 years to reach $1 million at this rate. This is where investing becomes a catalyst. Consider a scenario where you achieve a 10% annual return, akin to the S&P 500's historical average. In this case, you could amass $1 million in just 26 years. Investing's power dramatically accelerates your journey from 157 years to 26. Though investing might appear daunting and require substantial capital, it hinges on your perspective, either believing you need a lot to gain or understanding the potential with available resources. These perspectives are pivotal in steering your investment direction for years ahead. Distinguishing between short-term and long-term investing is crucial. Short-term investing spans under 3 years and entails greater risk, volatility, and taxes. Statistics indicate that approximately 90% of day traders and short-term investors incur losses. Long-term investing, spanning over 3 to 5 years, offers less stress, fewer risks, volatility, and taxes. Investing at any juncture proves favorable for the long term if you remain steadfast. Consider the Nasdaq 100 as an example. Imagine acquiring the QQQ ETF at its peak of around $52 in October 2007 before the 2008 financial crisis. The ETF subsequently dropped to $26. However, since you're investing for the long term, you haven't realized losses as you didn't sell. By October 2010, your investment would have rebounded. By September 2012, it could have surpassed $70 per share. In 2021, the value could have surged to over $403 per share, translating to an almost 800% gain. This exemplifies the beauty of long-term investing. A study by ASOS Investment Research spotlighted 10 years, November 2005 to October 2015. Their analysis concluded that missing the 10 best market days within this span could result in forfeiting around 66% of potential gains. These findings underscore the swiftness of market movements and the importance of remaining invested during upward trends. Therefore, whenever apprehension surfaces, remember that your money's potential is held back when left uninvested. If you stay on the sidelines, you risk missing out on some of the market's most opportune days. It's essential to understand that predicting the market's timing is near impossible, and the most effective approach is to remain invested without succumbing to panic. Media outlets often present alarming headlines, prophesying market crashes and chaos. However, here's a behind-the-scenes tip. Successful investors, including seasoned Wall Street professionals, don't succumb to such fear. They recognize that in the long run, the stock market consistently trends upward irrespective of its short-term fluctuations. Despite crashes, recessions, and crises, the overarching trajectory is long-term growth. Therefore, prioritize the extended timeline over the immediate one. Why should you consider investment funds instead of solely focusing on individual stocks that have exhibited impressive historical performance? You've likely come across stories of substantial profits from individuals who invested in companies like Tesla and Apple. While these anecdotes are captivating, it's crucial to acknowledge that past success doesn't always guarantee future outcomes. To illustrate, take the example of Nokia. In 2010, they held a dominant position with a 37.58% market share as a leading phone brand in the mobile market. However, a decade later in 2020, their market share had dwindled to less than 10%. During this same period, their stock price plummeted by nearly 70%. Our intention in sharing this isn't to dissuade you from investing, but rather to emphasize the importance of avoiding blindly following trends. Particularly for beginners, exercising caution is pivotal. Conversely, funds provide a convenient avenue if you're seeking a swift and uncomplicated entry into the investment realm. Below is a compilation of my preferred funds spanning various sectors. However, it's essential to recognize that these recommendations might not precisely align with your unique circumstances. It's advisable to heed these suggestions as you proceed. Here are 4 steps to help you determine the most suitable index fund for your needs, with the 4th step being particularly crucial. Establish your comfort level with risk, as certain index funds carry higher risk due to sector concentration. Next, examine the companies in the fund's portfolio and assess whether you align with their profiles. Third, evaluate the fund's historical performance, comparing it with simpler funds within the industry to identify potential alternatives. Lastly, analyze the fund's expense ratio, a significant factor. This ratio represents the percentage of the fund's assets charged as a management fee. For instance, if an index fund has an expense ratio of 0.2%, this translates to a fee of 0.2% of the total assets annually. A $10,000 investment would be a $20 fee for the year. While this might appear minor, these fees accumulate as your investment grows. Yet, there's one more fee to consider before taking action. Since your investments constitute a form of income, the U.S. government will seek a portion of your earnings, and the extent of this portion hinges on your gains or losses upon selling your stocks. To illustrate, imagine we purchased Apple stock a year ago for $1,000. Should our investment flourish and we sell it today for $1,500, this would equate to a capital gain of $500 subject to taxation. Conversely, if circumstances took a downturn and we sold our Apple shares for only $500, this would result in a capital loss of $500. In this scenario, we could deduct the sum from my taxes. However, there's a twist. Short-term investments face higher taxation compared to long-term ones, and this distinction is determined at the 1-year mark. If you bought and sold Apple within a year, your capital gains would be taxed at your highest applicable tax rate. In contrast, if you held Apple for over a year before selling, your capital gains would be subject to a considerably lower rate, potentially ranging from 0%, 15%, to 20%, depending on your taxable income and filing status. And there you have it, fellow aspiring investors. You've journeyed from being a stock market novice to a confident explorer of the financial realm. We've covered the basics, decoded the mysteries of stock trading, and unveiled the secrets of successful investing. Think of the stock market like an exciting adventure. It has its highs and lows, surprises and twists. The key is understanding and patience. Don't let temporary drops discourage you. Even seasoned investors face them. It's all part of the process. Becoming a successful investor requires time, dedication, and a willingness to learn. Stay focused on your goals, adjust to changes in the market, and keep refining your investment strategies. Hit that like button, subscribe for more financial wisdom, and don't forget to leave your thoughts and questions in the comments below. Remember, with knowledge and determination, your investment journey can lead to great success. Thanks for joining us on this journey. Check out more videos about fundamental analysis and technical analysis investing for beginners. These videos will surely help you make well-informed investment decisions. Until next time, happy investing!